Okay, so in this chapter, let's look at one further very important technique which will help you avoid those trades which don't keep you in the 7 times out of 10 being correct band. In other words, these techniques help make sure that you keep the 7 times out of 10 batting average, or whatever you want to call it, right up there. And this is where I look to combine my weekly and daily charts. Now, the chart you can see here is actually a daily price chart, a company called Energous, and you can see how it's moving across there. And let's say we had this up on our screen. We can see that the price is making lower highs. We can see that the MACD is strolling along here in oversold territory. It's starting to rise up around here. We're seeing the price rise up as well. We're seeing the stochastic has started to move higher. Seeing the momentum is moving higher, the relative strength index. We might want to get in as long as the downtrend is broken, maybe around here with a stop loss just underneath the trend line there. But if we're looking at this point here, are we absolutely certain we want to get in? Well, one of the things that I like to look at is the weekly chart. Now, that's not the only point I want you to focus on before I go on to the weekly chart. I also want you to look at these points all along here. What if, as this was trying to move higher, we thought to ourselves, oh, shall we get in here? Or at this point, how do we know that we shouldn't have got in here, for instance, when the price had moved higher and the MACD had moved higher and the stochastic was moving higher and so was the momentum, so was the relative strength index? How did we know that we didn't want to move in sooner and that we wanted to wait till here? Well, that's why I like to flick along and look at the weekly chart. As I said, this is the daily one. Well, what does the weekly one look like? What we can see here is the weekly chart. And as you can see on the weekly chart, the MACD is moving lower quite powerfully. Now, the stochastic gives us mixed signals. Arguably, so does the momentum and relative strength indices. That's to be expected with this. But the MACD is still strongly bearish. And when it is, I tend not to wish to go long. So what I would have done is ignored the daily signals because this is still moving quite strongly lower. When might I have ignored the daily signals? Well, I may have looked for some flattening of the MACD, maybe around here when we start seeing it give the first sort of uptick. Definitely looked at the weekly stochastic and said, okay, that's interesting. Also oversold, starting to move higher. Momentum, oversold, starting to move higher. Relative strength index, oversold, starting to move higher. Remember what I mean by oversold? It's in the bottom end of the chart, bottom end, and it's starting to move higher, which is a slightly bullish signal. Also, it's corroborated by the MACD, the stochastic, the momentum, and the relative strength index. So I'd probably be looking at something around here before getting in, and hey presto, look what happens. Bang, all the way from here, 750 to 1500. It pretty much doubles up in a couple of months. If you'd got in here, even though the daily charts gave some various signals which were mixed, it didn't actually get you anywhere. Now, what we think of this is, imagine on a weekly chart something which the longer term fund managers are looking at, and they look at this chart and they're forcing the stock lower. The short term traders are trying to move it higher by looking at the daily chart, but the medium term investors are still pressuring it lower. So when we looked at the daily chart, we thought it was going higher, but it was moving lower and lower, and the reason is because of this. What's happened is the weekly, the longer term investors win. And that's one of the very important reasons why I like to look at daily as well as weekly charts. Okay, moving on. What other kinds of price depictions do I like? Japanese candlesticks, for one. These work really well. As I mentioned before, got nothing to do with wax. Okay, there's 3 things we want to look at. Timing, psychology. So let's just check them out. Now, what do they mean? What do they do? Well, first of all, what they do is they depict in a slightly different way the daily price move. Basically, what you have to remember is if it's a white bar or white candle like here, it means it's been an up day, i.e. it's closed higher than it opened. And if it's a black one, it means it's closed lower than it opened. Okay, where's the open and where's the close? Well, the body represents the open and the close. If it's white, it's an up day, therefore this must be the open and this must be the close. If it's black, then it's a down day, which means this must be the open and this must be the close. Or similarly here, open, close. So what are these lines here? What are the wicks? The wicks just represent the high for the day and the low. High for the day and low. Sometimes the high and the low coincide with the open and the close, and so you might not have much of a wick at all. Fine. Well, how do these help us try and predict when prices are about to turn? Well, let me tell you. First of all, Japanese candlesticks have been used in the Orient for a couple of hundred years by rice traders initially around the 18th century. They're fairly accurate. They are good at predicting turning points. But which patterns? Well, I don't ever use them in isolation. I do like to use them with the MACD, the stochastic, the momentum. But what I tend to do, and on a weekly and on a daily chart, there are some patterns which seem to work fairly well. The engulfing bull is one of them. That's when the price has been moving lower and lower. Then all of a sudden, it opens low and closes above. So it engulfs the previous day's body. Why is it engulfing? Well, because it opened and closed so as to circulate the whole previous day. It's a 2-day pattern. But it's a bull because it's started low, closed up. That's an engulfing bull. It suggests prices are about to change. Lo and behold, they have done. Where would I enter on something like that? Well, if I'm quite risk-loving, then I might enter near the close of the first day there, or I might wait till the second day and enter only when the price has opened higher than the previous day and moved up a bit. And that gives me some degree of price confirmation. Well, what about other patterns? Engulfing bear, similar principle, 2-day pattern, you can see what happens there. That's one that I also tend to look at. You can see confirmation there, engulfing bear, and the price tends to move lower. There's a couple which I'm not too keen on. Rising window is one, and you can see it there. All that is a gap. In other words, the trend has been lower, the price then opens above the previous day's close and closes above it as well. And it's again a 2-day pattern, and that's why there's a gap there. Not one I particularly like. Engulfing bull, engulfing bear, definitely prefer those. And I think you get more mileage out of them. Let's just have a look at some of those rising windows again. You can see it there. As you can see, it gives you 2 days, fizzles out. There, well, okay, a bit more confirmation. Works well with the stochastic, so I might be more inclined to pay attention to it when corroborated. And this is the point of this window. Look for corroboration. Always look to see there's been some proof. Now, one of the patterns that I think works really well as suggesting a downturn is what's known as the Doji Star. And you can see it here. It's a 3-day pattern, and here it is. And what it is when the price makes a white body, so opens here, closes here. The next day, it opens and closes pretty much at the same level. There's not much of a body, hence they'll look like a star. Might move up and down. And then on the 3rd day, opens and then closes lower. That 3-day pattern, when it looks like this, suggests the price is about to fall. Now you can either sell short if you're a spread better or CFD around this point here, just as the day's close is happening. Maybe you'll do it at 355 or so. Or you can wait the next day if the price opens lower and then starts moving a little bit lower. You can see why it's advantageous to try and get in here, but the risk with that is the pattern may not be completed and it might shoot off that direction. Nevertheless, on the whole, when you see this 3-body pattern like this, white body, star, open and close near the same place above the previous day's high, and then the next day a black body, open, moves lower, that strongly suggests that the price is about to fall. Okay, next what we're going to do is give you a chance to interpret price charts yourself. We're going to do that in the next chapter. Whilst we do that, have a look at this and try and interpret how you think the prices might move from this point over here. What do these indicators tell you? And come up with a systematic analysis of which way the prices may go.